Welcome to BARR Financial Services market commentary for the third quarter of 2010. After completing extensive research, we provide these commentaries to share with you our insights to the economy and the markets. We hope you find these commentaries helpful, insightful, and beneficial. After the second quarter slide, global equity markets regained their footing in early July and rallied in the third quarter. The rise was neither smooth nor steady, but the equity markets finished with a strong September. In fact, this reflects the strongest September for U.S. equities since the 1930s. As indicated by the graph, the S&P 500 index climbed 11.3% for the third quarter and is up 3.9% year to date. In spite of the mounting evidence of a faltering economic recovery, the rising expectations for additional monetary easing by the Federal Reserve and the Bank of England were enough to climb the wall of worry and spur the giant September rally. The National Bureau of Economic Research recently announced that the Great Recession officially ended in June 2009. Making it the country's longest and deepest recession since the 30s. Despite the stock market rally, which started in March of 2009, with an overall growth of the S&P over 74%, we are still 22% below the peak reached October of 2007. There are some positive economic signs. Industrial production and earnings have rebounded strongly, much stronger than expected. Profitability is high, and companies have also very high levels of cash on their balance sheets. The personal savings rate rose to 6.1% in the second quarter, which, while not helpful for the near-term economic growth, it is necessary for the long-term healing of the economy. Interest rates remain low and relatively stable. Developing economies continue their high rate of growth and relatively strong fiscal debt balances, which should drive growth in demand for U.S. exports. Stock valuations look attractive based on almost all valuation models. As we review the S&P index at inflection points, we can see it dropped by 57% during the recession and has rebounded 69% at the end of the quarter. There appears to be room for continued growth as compared to the past recessions. The forward PE ratio of the S&P index, most recent reading of 12.3 times, is well below the average of 16.6 times, again suggesting stocks are undervalued. As we review the current valuation measures of the S&P and compare those to historical averages, it would again indicate that stocks are undervalued. For example, the latest reading of 8.3 for the price to cash flow is well below the 1, 3, 5, and 10-year averages, and significantly below the 11.2 reading for 15 years. Despite the strong equity results, the economic landscape in the U.S. and abroad remain uncertain and relatively fragile. While corporations appear fairly healthy, earning expectations have returned close to the 2007 highs. Companies remain reluctant to begin hiring at a meaningful rate. Joblessness remains at a multi-year high, and new jobs are being created at a rate that is struggling to just keep up with the labor force growth, let alone begin chipping away at the 9.6% unemployment rate. For the economy to grow stronger, the unemployment rate needs to drop significantly, which could take years. On a positive note, the Labor Department stated that initial claims for jobless benefits dropped by 21,000 to a seasonally adjusted 434,000 in the week ending October 23rd. The Conference Board's leading economic index, LEI, for the U.S. increased 0.3% in September to 110, following a 0.1% increase in August and a 0.2% increase in July. According to the Conference Board, the LEI has remained on a general upward trend since the end of 2008, but is growing at its slowest pace since the middle of 2009. They continue to state there isn't any indication of a relapse into another downturn through the end of the year, and the LEI suggests little change in the economic conditions through the holidays or the early months of 2011. According to the National Association of Realtors, sales rose 10% in September to a seasonally adjusted annual rate of 4.53 million. Nonetheless, the sales were 19% below the 5.6 million pace set September of 2009, when first-time home buyers ramped up in advance of the initial deadline for the tax credits last November. According to Lawrence Yin, chief economist for NAR, a housing recovery is taking place, but will be choppy at times depending on the duration and impact of the foreclosure moratorium. But the overall direction should be a gradual rising trend in home sales, with buyers responding to historical low mortgage interest rates and a very favorable affordability condition. Outlook and looking ahead. I believe the economy faces two significant headwinds over the next several years. The first is the high unemployment rate and its effect on personal income and consumer spending. Customer deleveraging, either by paying down debt or defaulting on it, is a second potential problem for the economy recovery. In addition to these two headwinds, I remain concerned about other potential economic developments. These include, first, a rising chorus of calls for fiscal restraint in Europe, the US, and Japan. Second, a Chinese economic slowdown. Third, stress in the Eurozone banking system. Fourth, concerns over sovereign debts. Fifth, indications of slower growth. And finally, the competitive currency devaluations and protectionism sentiments. In my view, the current scenario for the U.S. and global economies is to experience below average growth, a muddle-through scenario. As a result, I remain particularly vigilant and concerned with downside risk and will seek to manage accordingly. Our portfolios perform well during the recovery, and I firmly believe that the diversification of our portfolios will continue to be beneficial. Please forward this email to your friends and family and let us know how we can better serve you. Thank you for your ongoing support and confidence, and thank you for listening.